Welcome everyone. I am Dr. Gokilavani, working as an assistant professor in Kristu Jayanti College, Department of Commerce, UG. Our course title is Fundamental Financial Documents, a Beginner's Guide to Accounting, Module 2, Part 3. In this lecture, we will be discussing about importance of accuracy and timeliness in recording transactions. About the accuracy in recording transactions, we will be discussing about the components of accurate transaction recording and their consequences of inaccuracy. Regarding with the timeliness in recording transactions, we discuss about the importance of timeliness and consequences of delay. Then we will have our best practices and we will have a discussion. About the accuracy in recording transaction, it means about the financial activities of a business which is documented correctly. So we are going to ensure that whether it will reflect the nature and the details of each transactions correctly. So for maintaining the integrity of financial data, which is very essential for the reliable financial reporting and decision making for all the organizations of business. Regarding with the components of accurate transaction recording, we'll have 3 subpoints: correct amount, correct accounts, and proper documentation. All the organizations have to make sure that these 3 important components of accurate transaction recording. First one, correct amount. Regarding with the correct amounts, all the organizations have to record the correct monetary values, and also they ensure that financial transactions reflect the company's correct financial position or what. So how they can implement this involves double checking figures. So using accounting softwares, and they have to minimize their errors and verify the amount against original documents like invoices, receipts and bank statements. The second important component is correct accounts. There are various types of accounts, and also we have to remember the golden rules of accounting: the real account, nominal account and the personal account. So the companies must be allocated to the correct accounts to maintain the integrity of a financial data. How the company can implement this correct account details? First, they need to understand the chart of accounts and following the accounting principles to ensure that the revenue is recorded in the revenue account, whether the expenses is recorded in the expenses account, and they have to ensure that. So using this standardized procedures and consulting with an accounting guidelines will surely help the companies to have a proper accounting statements. The third important component of accurate transaction recording is proper documentation. Each transaction should be backed by the proper documentation. So whenever the business do some transactions, they need to have a proper documents like receipts, invoices, contracts or any bank statements which serve as a proof and provide details necessary for the verification and the auditing. How they can implement this proper documentation? To establishing a systematic filing, and they need to have a proper documentation process. Each and every transaction is mapped with their supporting documents. So they have to ensure whether all the documentations are complete, legal and stored securely for future references. So these are the 3 components of accurate transaction recording. Regarding with the consequences of inaccuracy, there are 4 consequences we have mentioned here. First one, misleading financial statements, errors in tax reporting, potential legal issues and poor decision making based on incorrect data. So when a company doesn't have inaccurate informations of the transactions, these are the consequences have to be faced by the organization. So we'll discuss in detail. The first one is misleading financial statement. So inaccurate recording sometimes lead to incorrect financial statements, which means it will not reflect the true and correct financial health of the business. So this representation can mislead even the stakeholders or investors or creditors and the management to misunderstood the financial transaction of a particular business. So to have an example, overstating revenue by recording a sales twice in a transaction. So when a revenue is recorded twice, even this will have a misleading financial statements. Sometimes even expenses will be missed out in recording with the symbols. It will also give you an inaccuracy profit figure, and it will affect the investment decisions and your company's market value. The second consequences of inaccuracy is errors in tax reporting. So if an organization have an incorrect transactions which lead into a inaccurate tax filing, and because of this reason leading to underpayment or overpayment of our taxes. So to understand with an example, misreporting expenses can lead to incorrect deductions, and inaccuracies in revenue reporting can result in incorrect income tax calculations. So both scenarios will trigger your auditing and assurance, and also sometimes the companies need to pay the penalties from the tax authorities. The third consequences is potential legal issues. So incorrect or false information, sometimes even it lead to legal issues. So the companies need to pay penalties, fines, or sometimes in the litigation issues will be there. So for example, to understand the potential legal issues, if financial statements are found to be inaccurate during an audit, the business could face charges of fraud. So this can also damage the business reputation and erode the stakeholders' trust. The fourth consequences of inaccuracy, poor decision making based on incorrect data. So when a management relies on financial data to make informed business decisions, so all the management people rely only on the financial data. So when there is an inaccuracy, this will lead the organization to misguided strategies and operational missteps. So for example, costs are understated. So if the cost is understated, the management might decide that to expand the operations without realizing the actual financial strain. Similarly, overstated revenue also sometimes lead to overspending or ill-advised investments. So these are the four consequences of inaccuracy: misleading financial statements, errors in tax reporting, potential legal issues, poor decision making based on incorrect data. So thank you. In this video, we have discussed about the accuracy of recording transaction. In next video, we'll be discussing about timeliness in recording transactions.